Welcome back to the Money List, where I break down the news for you and show you what's on my money list. In this video, we are going to break down 5 stocks that may be entering the S&P 500 this month. And are these stocks on my money list? And if they are, at what price? And before we get started, make sure you do your own homework before investing in any of these stocks. First up on the money list, we have a group of stocks that could join the S&P 500 this month, says Bank of America. And out of the 5 stocks, I am currently trading 2 of them, and I will show you my option calls later. And why do we like stocks that are entering the S&P 500? Because number 1, they are now solid companies with solid earnings, solid balance sheets, solid cash flow statements, and solid revenue growth, quarter per quarter and then year over year. And hedge funds and big money managers like investing in S&P 500 stocks because they have upside momentum. And the upside momentum comes from the revenue growth. And some of these companies that we are about to discuss can easily 10x their sales between 2 to 5 years. And if a company can do that, that means a 1 to 3x for investors on shares and 3 to 7x for investors with call options. So these stocks are quick, fast ways to make money over the next 2 to 3 years. And what are the 5 companies that are entering the S&P 500? Number 1 and 2, you have Robinhood and Interactive Brokers. And both companies have impressive balance sheets, income statements, and cash flow statements. But the advantage would go to Interactive Brokers because they have a higher earnings per share and they pay a dividend. Robinhood does not pay a dividend, but is growing at a faster rate. And if we look at a few statistics, we see that Robinhood has a 1.75 earnings per share, while Interactive Brokers has a 7.27 earnings per share. And Robinhood has to prove itself to get to $2 to $3 to $4 with earnings per share. And if we look at another statistic, we see that Robinhood is trading at a 42 trailing PE and a 50 forward PE. That is overvalued. And anytime a forward PE is higher than the trailing PE, that is a red flag. And the forward PE should always be lower than the trailing PE or thereabouts. And we can see as I'm making this video in after hours that Robinhood is down 6%. So my theory based on this number, which I just discovered, is proving to be correct because it's down 6%. And my price target for Robinhood is $62.50 or lower. And I do not think Robinhood will ever go lower than 45 a share. So my buying range for Robinhood is between 45 and 62.50. And I would love for Robinhood to go to $50 a share so I can place a call option at a $51 strike price and place it 2 years out as far as I can. Because I think a $51 strike price call option for Robinhood placed 2 years out will make 300% over the next 12 months. But if I cannot get Robinhood at $50, then I will take $60, even $65. I just might have to wait 3 to 6 months more as I'm waiting for the call option to expire. And when we look at the Interactive Broker numbers, we see that it's trading at a 29 trailing PE and a 28 forward PE. Normally, we would like to see a lower forward PE, but because Interactive Brokers has such a solid earnings per share, they don't need it. So you can expect Interactive Brokers not to sell off more than 10% in one day because they're so solid. And if they get to $10 earnings per share, expect the stock price to go up 10, 15, 20 to 40%. And Interactive Brokers managers are very well at managing money, so I expect this to happen. And my price target for Interactive Brokers is at its current price or anything lower. And because I think the market will pull back because of Trump's tariffs, the war in Ukraine, the war in Israel, and the Elon Musk drama will cause another sell-off. So I'm looking to get Interactive Brokers at around 190 and if I could, 180. And I would do the same thing as I'm doing with Robinhood, which is place a call option 2 years out. And I think that this call option for Interactive Brokers could yield a 200 to 300% return, as the Robinhood return would be about about 400 to 700% because Robinhood is more volatile and it spikes up and it spikes down. So if you know when to buy when it spikes down, you can rinse and repeat the process as it goes back up again. The next three stocks that are entering the S&P 500 are Flutter Entertainment, Cheiniere Energy, and Invesco. And I'll be honest, I do not care about Cheiniere Energy, which is a natural gas company, and it's a slow-moving stock. It either moves very slow up or it doesn't move at all. And I think Cheiniere Energy will trade sideways for the next 2 years. And the fifth stock entering the S&P 500 is Invesco. And I honestly do not care about this stock. I will not waste any time because there are much better places to put my money right now. Now let's talk about the third stock that may enter the S&P 500, which is Flutter Entertainment. And Flutter Entertainment owns FanDuel, which is a sports betting app. Flutter Entertainment also owns Sky Betting and Gaming, Paddy Power, Betfair, Sportsbet, and PokerStars. So Flutter Entertainment has a number of revenue streams and their numbers are very impressive. As we look at the Flutter Entertainment numbers, let's compare it to DraftKings, which is another one of my favorite stocks, but has nowhere near the better valuation than Flutter Entertainment. So the first thing we notice with DraftKings is that they have a negative 0.82 earnings per share, while Flutter Entertainment has a positive 2.82 earnings per share. So Flutter Entertainment is killing DraftKings with earnings per share and managing their money better. And DraftKings claims to be profitable, but I don't see it in any of the numbers. So I don't know what they're talking about when they say they're profitable because they have never had a positive earnings per share. And in my book, I don't care how good your numbers are, if you do not have positive earnings per share that are growing higher, you're not profitable. Another important number is the negative profit margin for DraftKings. They have a negative 7.97 profit margin and a negative 3.29 operating margin. And until that operating margin becomes positive, DraftKings cannot have positive earnings per share. Meanwhile, Flutter Entertainment has a positive 6% operating margin. So they are killing DraftKings because we do not know when DraftKings will have a positive operating margin. They could be trading flat and sideways for the next year. So until DraftKings has a positive operating margin, they are much more riskier than Flutter Entertainment. And the stock will not go up unless that operating margin improves. So I'm worried DraftKings will trade sideways for the next year until they have a positive operating margin. Meanwhile, Flutter Entertainment could be improving their operating margin to, let's say, 7% to 12% or 15% over the next 12 to 18 months. And this could add 20 to 40% in the share price to the upside. And the last number I want to look at for DraftKings is the revenue at $5 billion. And Flutter Entertainment's revenue is at $14.3 billion, which makes Flutter's entertainment 3 times more greater than DraftKings. So we can see that Flutter Entertainment can easily grow their operating margin and increase their earnings per share versus DraftKings. So my advantage goes to Flutter Entertainment by a long shot. And I think Flutter Entertainment has a 3x better valuation than DraftKings at this moment in time. And obviously the S&P 500 agrees because DraftKings is not a candidate for the S&P 500, but Flutter Entertainment is. So that just shows you right there. But that did not stop me from buying calls on DraftKings, and here's why. Every time DraftKings goes below 35, it usually runs back up to 45, 50-ish. And this usually starts to happen when football season starts until the Super Bowl ends. So the run-up will take about 8 months until February of 2026 when the Super Bowl ends. And DraftKings usually sells off after the Super Bowl because they have proven once again that they're not profitable. So my 2 option calls for DraftKings, expiration date is March 20th, which is plenty of time after the Super Bowl, at $35 strike price and a $37.50 strike price. And if DraftKings goes to 34, 33, or 32, I will place another call option. because I think any price lower than 35 is a good buy for DraftKings because they may become profitable. They may turn a positive operating margin, and they may show a positive earnings per share. And this is my DraftKings call options. And you can see on the $35 strike price, I'm already up 28.31%. And on the $37.50 strike price, I'm up 15.23%. And I will make 100% to 250% on both of these call options. And this is an easy no-brainer. So if you want to make 100 to 300% easily, make sure you subscribe and watch the next Money List video. And be on the lookout for my options classes, which I'm currently recording, where I teach you how to double, triple, or quadruple your money with as little as $300.